Hello, this is Asilis from Glovista Investments, here to share a market outlook for the week of June 21st. First, a brief recap on this past week's major macro and market developments. At the macro level, the activity calendar continues to confirm the rotation of economic momentum leadership away from the US to the rest of the world. For example, a number of economic releases out of the US, the majority of it, this past week, surprised to the downside, including retail sales in power manufacturing, Philly Fed manufacturing, NHB housing index, as well as housing starts and building permits. Conversely, out of the rest of the world, in particular the Eurozone, industrial production figures surprised to the upside. Similarly, UK average earnings surprised to the upside. Australia employment figures also surprised significantly to the upside, along with upward revisions to the prior monthly reading. Without any doubt, the major development at the market level this past week was that of the FOMC meeting. So it was a policy shock, if you will, given that this much anticipated meeting by the FOMC was expected by the markets to result in revisions to both economic projections by the FOMC members, as well as revisions in terms of the guidance of the timing by when the first policy rate hike would occur. Prior to this past week's meeting, the expectation had been that the first rate hike would take place in 2024. In the process, medium and long-term economic projections by the FOMC were largely unrevised. By that I mean inflation and GDP growth forecast. However, the 2021 core PCE inflation estimate was upwardly revised to 3%. In the process, a majority of FOMC members essentially moved forward to 2023, the date by when the first policy rate hike would occur. And this action was a surprise to the market, given that under the new average inflation targeting paradigm, the reading on the part of professional economists and market participants was that of a Fed that was likely to prove patient in terms of allowing for temporary inflation overshoots. So in a nutshell, the meeting was a hawkish one. In the process, the dollar, of course, rallied, and a number of positions that were somewhat crowded over the short term, particularly value sector tilt overweights and growth sector tilt underweights, of course, reacted quite aggressively and viciously to this hawkish surprise. So at the market level, if we look back at this past week, the S&P 500 corrected by 1.87%, Russell small caps corrected by 4.2%, international developed equities, EAFE, corrected by 2.4%. Emerging market equities outperformed all others, declining only by 1.4%. In addition, the reduction in long-term inflation premia resulting from the hawkish tone of the FOMC meeting resulted in a decline of long-term US Treasury yields by about 12 basis points, and the yield curve, of course, flattened, reinforcing this rally by this outperformance by growth stocks. If we look forward, our stance in terms of what this FOMC signifies to the outlook is one of pricing in pretty much a fair amount of rate hikes. The market by the end of this week was pricing in 3 policy rate hikes, 3 25 basis point hikes by the end of 2023, as opposed to the current FOMC consensus of 1 rate hike. In addition, the 1-year rate, 5-year forward futures market essentially has now converged to the long-term Fed funds equilibrium level embraced by the FOMC. Glovista, we sustain our overweight and our preference for emerging market equities, a number of value-oriented sectors globally, particularly in the US, industrials, energy, and materials. And we continue to favor secular growth sectors, particularly in the US, that get mega cap tech. This week, the activity calendar is relatively light. We have the scheduled release of May US PCE, Chicago Fed National Activity, University of Michigan Sentiment, and Richmond Fed. Out of Asia Pacific, we have trade data out of Taiwan and South Korea Manufacturing Survey. Thanks for your time and have a good week.